You're watching episode 57 of the Tax Smart Daily, a daily video series for real estate investors to learn how to be tax smart. Before we get started, make sure to subscribe to our YouTube channel and click the bell icon to receive notifications about future videos that we release. Thanks for tuning in to today's episode of the Tax Smart Daily. I'm Brandon Hall, a CPA and managing partner at the Real Estate CPA. And before we get started, I invite you to join the Tax Smart Facebook group. A link to join is below. We're having a lot of really fun conversations about taxes, accounting, and real estate in that group. Highly recommend that you jump into the action. Today's topic is about exiting real estate. So what happens when you buy real estate, you've let it run its course, and now it's time to sell? You want to get out for a variety of reasons. That's what we're going to talk about in today's episode. Now, there are many ways to exit real estate, but we're going to talk about the three main ways and what you should be aware of regardless of which way you go. So before we even talk about the three main ways to exit real estate tax efficiently, the first thing that you have to figure out is, why do I even want to exit real estate? Am I exiting this real estate deal because I'm trying to free up capital to buy new deals? Am I exiting the deal, but I really want to trade up? I want to get into bigger deals and better deals, or maybe I want to be more passive. So I want to be in a partnership where other people are managing my replacement asset. Or do I just want to get out of real estate totally because I'm done with it and I don't want to deal with the tenants anymore? Because answering that question is going to help us define which route we should take when we start talking about how do you exit your real estate. So let's start with the investor that just wants to leave real estate for good, doesn't want to deal with tenants anymore. There are two things that type of investor should explore. First, they should look at Form 8582 to figure out if they have any suspended passive losses that they're carrying forward, because that'll help them understand if they can just sell the property and not pay tax on any sort of gain, because the suspended passive losses are going to offset that gain, or if they're going to have too much gain and the tax is going to be too large, and we should look at option number 2. And if Form 8582 is new to you and whatever I just said didn't make any sense, you don't know how to find your suspended passive losses, go check out Tax Smart Daily episode number 49. I go through it. I show you the exact form in your tax returns. It's a really good walkthrough. So let's say that you don't have any suspended passive losses. You're just selling rental real estate at a gain and you're trying to get out of real estate. You don't want to deal with the tenants anymore. The best way to do this tax efficiently is to actually do seller financing. So you want to carry back a note. Now, you can only do seller financing if you have a lot of equity in the property, because somebody still has to pay off your own mortgage, and then you're going to carry back a note. So if I'm a buyer, let's say that you own a $100,000 property. I come in and I buy that $100,000 property, and let's say that you have 100% equity, so you don't have any debt on the property. You might require from me a 10% down payment, so I'll give you $10,000 up front, and then you're carrying $90,000 of your equity that I'm going to pay down over time as the buyer of your real estate. So you are carrying back a note, and it's a really good way to exit real estate because you recognize the gain from sale, or the gain on sale, as you receive payment. So you recognize gain when I gave you that first $10,000 check, and then every month later that I pay you for the note that you're carrying, you're going to recognize gain associated with each one of those payments, as well as a little bit of interest income. So instead of recognizing all the gain in year one, you might have a 10-year note and you might recognize the gain over 10 years. Really great way to spread the tax out, especially if these Biden changes get implemented. You need to be looking at that installment sale, seller financing. Now, the big con with seller financing is that if I, as the buyer, and you as the lender, if I turn around and decide that I'm going to sell the property before the note matures, you're going to be paid off all at one time. So you lose a little bit of control, because you could be in year 6 and then all of a sudden the entire remaining balance of your note gets paid off, and you have to pay tax on that entire remaining balance at that time. So that is some risk that you carry whenever you are doing seller financing or installment sales. But let's say that you're the investor that wants to stay in real estate. You don't want to get out of real estate. You love real estate, and maybe you just want to trade up. Maybe you want to buy a bigger and better property. You've got two ways of doing this. The first is a 1031 exchange. So to explain a 1031 exchange, I want you to think of the game Monopoly. You remember playing that as a kid. You would try to get all the orange blocks in one go, and you try to build your greenhouses. But when you get 4 greenhouses, you can trade up for a hotel. And that's what a 1031 exchange is. It allows you to trade up without paying tax. So maybe I've got this $100,000 property, and maybe I bought it for $70,000. Now it's worth $100,000. Well, if I sell it for $100 and then go buy another $100,000 property, I've rolled the gain forward. And then maybe a couple years later, that $100,000 property is now worth $150,000. Well, I can sell that and I can go and buy a more expensive property. So I'm just rolling the gain forward. I build this gain up over time, and I just keep rolling it forward with a 1031 exchange. That's one of the best ways to invest in real estate. Over time, over decades, you're going to see a lot of appreciation, and you can just keep kicking the can down the road with 1031 exchanges. But there's a second way to accomplish this. And remember, this is if you want to stay in real estate and keep buying bigger, larger assets. There's a second way to accomplish this, and that's using your passive losses effectively. So if you have suspended passive losses that you're carrying forward, you can just sell your property outright. The passive losses make it go away. So if you think about the application of how to use these passive losses, you may be able to put 2 and 2 together that you can sell a property at a gain in one tax year, one calendar year, and you can buy a replacement property without doing a 1031 exchange. You can cost segregate that replacement property. It's going to create a large bonus depreciation deduction that you can then use to offset the gain on sale of the property that you just sold. So if I sell a property, I sell it for $100,000. There's a $30,000 gain built into that. So I've got $30,000 flowing through to my 1040. I could go buy another property for $100,000, cost segregate it, get a $30,000 depreciation deduction. Maybe that turns into a $25,000 tax loss, and that $25,000 tax loss can offset my $30,000 of gain. So I've sold a property and bought a property in the same tax year. I haven't done a 1031 exchange, but I did cost segregate the new property, which increased my bonus depreciation deduction, which increased my taxable loss as a result. And that taxable loss can offset the gain on sale of the property that I sold. So it's kind of a roundabout 1031 exchange. If the 1031 exchanges do get limited or eliminated with the Biden tax plan, I would fully expect to see you using this passive loss strategy, using that cost segregation strategy. Now, the downside to that strategy is that bonus depreciation is going to be phased out over the coming years. So get with your advisor, make sure that this makes sense for you. And the last strategy to exit real estate is for the folks that want to stay in real estate. They want to get bigger properties, but they're tired of dealing with the tenants. So we're not talking about people that want to get out of real estate and just want to carry notes. We're talking about people that want to be in real estate. They want to own the assets, but they're just so tired of the day-to-day operations. If that's you, you can 1031 your property into a DST. That DST is going to be managed by a sponsor, professional management. There'll be a bunch of people 1031ing into the DST, and you can own a slice of a larger property through a TIC arrangement, tenants in common arrangement. We've seen that happen pretty successfully over the past few years as well. And then you don't pay tax on the sale because you're 1031ing into the DST. And the best of both worlds is that you don't have to manage that property that you're 1031ing into. It's going to be professionally managed for you. Thanks for tuning in to today's episode of the Tax Smart Daily. If you have any comments or questions, please drop them below. I love engaging with our community. And please follow us online. We've got a whole bunch of social links. We'd love for you to be a part of our larger community.